Welcome, everybody, to Tokens of Wisdom. I am your host, Dave Rothschild, a partner at Cole, Freeman & Mallon based in San Francisco. And before we dive into the content today, please remember to listen to the disclaimer at the end of the show. Nothing I say here is legal advice, investment advice, or tax advice. So the topic for today's episode is the latest example of California's regulatory overreach. That's right, starting March 1st, 2026. That's less than 3 weeks away for those of you counting at home. California is going to require certain VCs, well, in reality, most VCs, which we'll get to in a second, to survey the businesses they invested in during the prior calendar year about their founding team members' demographic data, and then report that information to the state, who will turn around and make it public to everybody. This law is technically called the Fair Investment Practices by Venture Capital Companies Law, FIPVCC for short. But it might be more accurately described as just the latest example of California's regulatory overreach. The only thing more overreaching than the insanely long name of this law is how burdensome it will be on VCs, really worldwide. So let's get into the details of why. Today I'm going to walk through the who, the what, and the when of this latest requirement, and then I'm going to end the episode by chiming in with some off-the-cuff thoughts on this latest requirement. Review, I think this is dumb. It's going to be a fun episode. So let's start off with the who. Who must report? It applies to any covered entity, which has two elements to it. So the first element is you have to be a venture capital company. Now, in California, venture capital companies have a very long and very specific definition, but the TLDR is it's an entity that primarily makes investments in the equity of pre-public companies. So you're buying equity in startup companies directly from the issuer, you're probably a venture capital company, per California's definition. The second element of making someone a covered entity is that they have a nexus to California, which means one of four things. You're either headquartered in California, you have substantial operations in California, you invest in companies that are either headquartered in or have substantial operations in California, or you receive investments from California residents or any California resident. So in other words, if you're based in California, you invest in companies in California, or you have LPs from California, you have a nexus to California, and if you're also a venture capital company, then you are a covered entity for FIPVCC. Very exciting. So we've now determined that you're a covered entity. What do you actually have to do? A handful of things. First, all covered entities have to register with the California Department of Financial Protection and Innovation. This agency has been renamed more times than P. Diddy. Too soon? Maybe. So, second, once you've registered, every covered entity has to send a survey to each business they invested in over the prior calendar year, and the survey asks for demographic information about their founding team members. Now, the surveys must be sent by the covered entity. If you're a covered entity, you have an affirmative requirement to send this survey. But if you're one of the businesses in which covered entities have invested, you are not required to fill out and return this survey. So it's entirely optional whether you fill it out or not. But as a covered entity, you have to send it to every business that you've invested in. And by demographic information, I mean the survey asks about gender identity, race, ethnicity, disability status, LGBTQ plus status, veteran status, and California residency of the founding team members of that business. Third thing the covered entity has to do is aggregate and anonymize all of the data that they collect from these businesses in response to these surveys, and then report that information to the state. It's not just the raw demographic information that you have to report. You actually have to report what percentage of your investments were made in companies with diverse founding teams, which the law defines as a company where more than half of the founding team members responded, and at least half of the respondents identify as diverse. So what percentage of your total investments were made in companies with diverse founding teams? Again, as self-reported voluntarily. And finally, California is then going to turn around and make these reports publicly accessible to just about anybody. So when must this all occur by? Covered entities have to register with the DFPI by March 1st, 2026. Checking my calendar, that's less than 3 weeks away. Okay. Second, covered entities have to submit their first report to California by April 1st, 2026, and then every year thereafter. So to summarize, the who is basically any venture capital company, except for those few who aren't based in, don't make investments in, and don't have investors from California. The what is you have to register with a state regulator. You have to send every business you invest in a survey. You then have to aggregate and anonymize any survey responses you receive and report that aggregated, anonymized data to the state, and the state will turn around and publicize that information for everybody. And you have to do this every year from now on. So that brings us to the part of the show where we get into my thoughts on this latest requirement. First of all, why? Why? I struggle to see the practical benefit these reports could serve, even if you concede that publicizing data about the diversity status of founding team members in which VCs invest serves a social good, and I think that reasonable people could debate that premise already. These reports will be unreliable. All of the data reported is voluntary and self-reported by the underlying companies. Will certain demographic groups be more likely or less likely to reply to these surveys? It's certainly possible. But it also means that whatever reports the VCs submit to the state and that the state then publicizes to everybody are almost certainly going to undercount the number of diverse founding team investments. The reason for that is that if someone doesn't report, whether they're diverse or not, that investment is going to count in the denominator of this calculation, but it won't count in the numerator. So you're counting all investments in the denominator, and you're only counting as diverse founding team members, the people who responded and that met the diversity metrics the state has designed. It seems like a lot of administrative process and hoop jumping for VCs to provide faulty data to the public. Second, this is so overbroad. There can't be that many VCs who don't have either an investor from or an investment in a company that has operations in California. I mean, California is much maligned globally, but it remains the startup capital of the world. I'm here in Silicon Valley. It's called that for a reason. A huge percentage of global startup companies, i.e. the kinds of businesses in which VCs invest, are based in or have operations in California. That's for all kinds of reasons which are beyond the scope of today's episode, but I imagine it's not that easy to be a VC and just X California off the map of places where you might make an investment. Plus, this information is all publicized, so your limited partners, your competitor funds, your dog walker, your mom, and everybody in between is going to see all the investments that you're making and in what size. That seems a little over-intrusive, if you ask me. Third, this could be a legitimate administrative nightmare for VCs, especially larger ones that make a lot of investments. Sending the survey, tracking that you've sent it so you can prove it if the state comes in and asks you about it, maintaining a record of responses, anonymizing and aggregating all the data, consulting with your lawyers and compliance consultants about what you have to do and what you can get away with not doing. This sounds like a tremendous burden. And again, going back to the why of it all, we're knowingly providing faulty data to the public. So what useful purpose is this going to serve? Fourth, could this alter even subconsciously the investment decision-making process for certain VCs? I admit this is probably unlikely, but a VC who is particularly sensitive to perceptions of their concerns for diversity might be more willing to make an investment in a business with diverse founding teams or to avoid investments in businesses without diverse founding teams. And anytime you're encouraging VCs to consider interests other than what they promised investors, it's a recipe for trouble. Fifth, there are large potential penalties for noncompliance. There's a bit of a cure period, but after that expires, apparently California can seek penalties of up to $5,000 per day for people who are late making these filings. I have no information on how they're going to enforce this, what they're going to be looking at, but at least in theory, the penalties could add up pretty quickly if you just ignore this requirement altogether, which you definitely should not do. Again, not legal advice. And sixth, California, as usual, is not ready for prime time with this. Like I said earlier, I just checked my calendar. The registration deadline is less than 3 weeks away, and the website through which California mandates registration does not even exist yet. It's not up and running. This is kind of like the high-speed train to nowhere fiasco. Like, you can't impose a requirement that we do all this stuff by March 1st, and it's February 10th right now, and you don't even have the website open through which we have to comply. So I'm not really sure what they're expecting here. Is the website going to go live on February 28th, and then on March 1st, they're going to expect that everybody has done this? I doubt it. And so those are my quick off-the-cuff thoughts on this latest California requirement. I do have one piece of advice, assuming this doesn't get stayed or reversed and that this requirement does go into effect for any VCs that are covered entities that become subject to this requirement. Revise your post-closing checklist so it's just part of your normal process that you send out the survey to the businesses in which you invest immediately after closing the investment. If you do that and you send it via email and you keep records of that email, you're going to have the proof that you complied with the requirement to send the survey. And then if people don't respond to it, people don't respond to it, and that's not your issue. Okay, with that scintillating conversation out of the way, we can get to the part you've all been waiting for. The legal disclaimer. On this show, my guests and I discuss laws, regulations, and aspects of fund management from a 10,000-foot view. And nothing I say here, nothing my guests say here is legal, investment, or tax advice. Everything we say is our own personal opinion. Nobody is speaking on behalf of their employers on this show, and it is entirely for educational purposes only. If you're thinking about starting a fund or you're curious about what's involved, this show is a good resource as you explore your options. But if you're going to pull the trigger and actually launch a fund, please engage professional service providers to assist you in the process.